So, you want to make money in the stock market, right? Well, you've probably heard people talk about investing and trading. They might sound kind of the same, but trust me, they are two totally different games, and the one you choose could change everything. So let's figure out which path might be for you.
Believe it or not, the entire difference between an investor and a trader, it all boils down to this one simple question. It's all about time. How long you're planning to hold on to something is the single biggest thing that separates these two approaches.
Think of it this way. Are you running a marathon or a sprint? An investor is the marathon runner. They're in it for the long haul, aiming to build wealth slowly and steadily over years, maybe even decades. A trader, on the other hand, is a sprinter. They're looking for quick, short-term profits, jumping in and out of the market in weeks, days, or sometimes even minutes.
All right, let's kick things off with the marathon approach. Investing. If you choose this path, your best friend is going to be one thing: patience.
See, the investor's whole philosophy is pretty straightforward. Find a really great company, buy a piece of it, and then just hold on. They aren't stressing about the daily news or small price tips. The core belief is that a solid, well-run business is just going to be worth more in the future.
Okay, so how do they actually pick these companies? Well, this is where they basically become financial detectives. They use a tool called fundamental analysis. And this isn't about looking at squiggly lines on a chart, it's about doing a deep dive investigation into the company itself.
So what kind of evidence is our detective looking for? They're digging into the real stuff: the company's profits, its sales, how much debt it has, and where it stands against its competitors. The key takeaway here is simple. For an investor, the health of the actual business is what matters most.
And if you're wondering what all that patience can get you, check this out. Imagine you bought just $300 of Apple stock way back in 2008. If you just did nothing and let it grow, that little investment would have turned into around $22,000 by 2024. That's the power of the marathon.
Okay, we've walked the marathon. Now it's time to shift gears and talk about the all-out sprint: trading.
Yeah, trading basically takes that whole buy and hold idea and throws it right out the window. Traders are always on the move, buying and selling super frequently. They're trying to catch those little, rapid price swings in the market to make a quick buck.
And just like investors have their detective work, traders have their own special tool. It's called technical analysis. With this, you can forget about the company's profits or leadership. A technical analyst lives and breathes price charts, looking for patterns and trends to predict where the price may go next.
And this really gets to the heart of the difference in mindset. An investor is focused on, is this a good, solid company? A trader could care less about that. They have one question, and one question only: where is the price going next? For them, the chart is everything.
But wait, it gets a little more complex. Even within the world of sprinting, there are different speeds. The two big ones you'll hear about are day trading and swing trading. Let's quickly see what makes them different.
Let's take a look. Day trading. Man, that's the super fast lane. You're buying and selling so fast you have to close all your positions before the market closes for the day. It's basically a full-time, extremely high-stress job. Then you've got swing trading. This gives you a bit more breathing room. You might hold a trade for a few days or a couple of weeks. It's more flexible, but as you can see, the stress level is still way up there.
So yeah, trading sounds intense, maybe even exciting. But let's ask the really important question here. With all that pressure and risk, how many people are actually winning at this game?
Okay, get ready for this because the numbers are pretty shocking. When you look at day trading, studies show that only about 1%, just one, are consistently profitable over the long term. That means 99% of people who try it fail. It's an incredibly difficult game to win.
Now, the odds do get a little better with swing trading, but it's still a huge challenge. Here, the long-term success rate is estimated to be somewhere between 10 and 30%. I mean, that's better, for sure, but it still means that even in the best-case scenario, 7 out of 10 people who try this don't succeed.
Okay, so after all that, the big question isn't which one's better, it's which one, if any, is right for you.
First, you've got to be real with yourself. What are you actually trying to do here? Are you trying to build wealth slowly over a long period of time? Or are you chasing those quick, high-risk profits that trading offers?
And it's not just about money, it's about you. How do you handle pressure? Can you really stomach the stress of watching your money go up and down every single second? And do you have the time? Trading isn't a hobby. For many, it's a job that demands your constant attention.
Look, at the end of the day, there's no magic answer here. There's no single better way to do this. The right path is the one that actually fits your goals, your personality, and how much risk you're truly comfortable with. It's a choice that only you can make. And I want to leave you with this quote from Warren Buffett, probably the most famous investor on the planet. He once said, "Nobody wants to get rich slowly." And that really captures the whole debate, right? The slow, patient, proven path of investing versus the fast, exciting, and very risky world of trading. So the question is, which path makes more sense for you?